Hey guys, it's Cash with Dara. What's good in the financial hood? Today we're going to be going over valuation, which is valuating a company. So, valuation, in addition to valuating the company, more specifically, is the pricing of a company. Is it worth the price that you're going to pay for the stock? So, I'll show you how you can determine this with this example. So, we got Square Inc. here. And you can see here are the valuation measures that I've pulled up for us. And so I'll just be explaining what each of these means real quick for you guys, and then we can talk more about it after. So market cap, that's the share price times the amount of shares it has outstanding. The enterprise value is the market cap, but in addition to what this shows right here with the stock price and the shares outstanding, it also factors in the amount of cash the company has and the amount of debt, long-term and short-term, that the company has. So this one's a little bit more holistic, and this one mainly deals with just the stock price. The price to earnings ratio, which you can see in both of these, is the share price of the company divided by the earnings per share of the company. And for these, the lower is better because, as you can see, the denominator is earnings, the earnings per share, and a higher earnings per share is better, and a higher denominator means the overall fraction becomes less. Simple math. PEG ratio is the price to earning. Oh, and by the way, the trailing is trailing 12 months. The forward is forward 12 months, and the way the earnings factor in for forward, because it hasn't happened yet, is based on predictions. And so the PEG ratio is the price to earnings ratio, which is this, but also divided by earnings per share growth. So factoring in that performance, basically. And then you also want a lower version of this too. Price to sales, that's the market cap of the company divided by the revenue of the company. And as you know, revenue is the amount of money that the company brings in. So lower is better for that as well. And then the price to book is the market cap of the company divided by the book value of a company. And the book value of a company is basically all of its tangible assets. And what that is anything in the company that you can touch. So factories, buildings, cash, all of that, cash, and then, all that stuff that you can actually touch. That's the best way for me to think about it. For example, something that wouldn't count is ideas. Like, technically, what you can do is you can value the, like, someone's intelligence when you're factoring in the company. And this is kind of going off task into more accounting, but yeah, like also the value of patents, basically. If you're just self-valuating the patents as a company, it kind of takes that out of the picture when you're just doing the book value of a company. So just think of book value as anything that you can touch in the company. So, and that ratio is also pretty helpful because it's less ambiguous and like you can less easy to manipulate because you can value ideas at whatever you want because it's more subjective. But the book value, I mean, a building is worth as much as the building is worth. Like, you can't give, that's not really opinionated. Anyways, that's kind of going off on a tangent there, but yeah, the book value is anything you can touch. And then the enterprise value, which we went over here, which is the market cap including cash and debt, divided by the revenue. Pretty self-explanatory. Obviously, if revenue is higher, the number should be lower. And then EBITDA is earnings before interest, tax, depreciation, and amortization. So this is like basically all the different taxes and ways that money will become less, because when you get revenue, you got to like pay all of your taxes. Basically, these are all different forms of taxes. Some are depreciation and amortization. Those are just like accounting for the loss in value. Yeah, I don't want to like go off on this because it's not the main focus of the episode, but yeah, just know that this is like with all the nitty gritty stuff. that shows the true money that you've made. And so knowing all of these, like how you can calculate them, kind of explains it. Usually the denominator is earnings, so a lower one for all of these is good. But, and this is a big but, you gotta understand that when valuating a company, you can't just valuate it in a vacuum because you're doing pricing. When you go to, I don't know, buy a fan, you don't say like, oh, $20 is super expensive for a fan. Like, how do you know $20 is expensive for a fan? You compare it to other fans, other brands of fans. You know what I'm saying here? So, comparing this to another company that does kind of the same thing, we have PayPal, which also deals with online cash transactions. And as you can see here, without going over all of these again, it's significantly lower. So this means that this company is essentially valued less than Square. So if you're just going off of valuation measures, PayPal is a better bang for your buck. Not saying that it actually is. I mean, valuation wise it is, but like not going into all of the other ways of analyzing the companies, purely valuation, which is the focus of this episode. PayPal is the better bang for your buck, as you can see, because these ratios are a lot lower, so it's more fairly priced. And price to like another way that to re-emphasize this idea of you got to look at the company in the context of its sector. Here are all the different sectors, and the average price to earnings ratio and all the other valuation ratios differ from these different sectors. So, for example, in healthcare and technology, the average price to earnings and other valuation measures are going to be a lot higher than, let's say, consumer staples or real estate. So if the average in technology is around 40, and then the average in like consumer staples, I'm not sure what it is, but I'm guessing it's probably around 15. Like if you saw 40 and 15, you think, oh my god, like you'd be freaking out. But no, like technology on average is higher, healthcare is higher, consumer staples is lower. So the message here is just you got to look at everything in context with its competition with the other participants, if you will, of the sector. So just the summary here, valuation is pricing the company. You got to view the companies in the context of their competitors to see which of those companies is, the better value. This is just one piece in the holistic review. I will talk about all the other pieces in future episodes, but I can't just make a 3-hour long YouTube video. And then what you want to do is you want to ask yourself, is this stock worth the price? There are other factors, again, that I will go over in the future, but this is just valuation, as you saw with the PayPal and the Square examples, like purely valuation measures. PayPal is the superior company, and you want to ask yourself, but even if you're still going to buy Square, you ask yourself, is the stock worth the price? It's overvalued, but do I think that matters currently? Yeah. Yeah, it's kind of hard to like talk about just one aspect, when this stock picking is a holistic review. But yeah, valuation, pricing, view in context of its competitors. Have a good day, everybody.